Good morning, everybody, and welcome to our September webinar. I hope it's nice and sunny and warm wherever you are. In Melbourne, it's raining, as you know, Melbourne rain, quite depressing. So it's the weather and the lockdown that's getting us down at the moment. As always, I have with me Kevin Frobus. Kevin, please tell me it's looking better in Sydney.
Well, good morning, everybody, and good morning, Aletta. And it's looking terrible in Sydney this morning. When I was lying on the beach just before I went in for my morning dip, I have to say it was probably the worst morning I've ever seen in Sydney, except it's the best morning I've ever seen in Sydney. It's a wonderful sunny day here, and I'm sorry, Aletta, but there's no lockdown and there's no rain. But what can you get for choosing Melbourne over Sydney?
Kevin, I walked into that one. I actually set it up beautifully for you. But for all our attendees, I hope wherever you are that you are healthy and safe. And if you are in Melbourne, please stay sane and stay safe. But welcome to our webinar. So this month's webinar, we're following on from our webinar last month. Last month, we looked at finance teams and we asked, what should finance teams look at when they prepare financial statements? What should they be focusing on? So this month, we say, okay, it's a month later. Let's look at board members. Finance teams have prepared financial statements. It lands on your desk or in your hands, on your iPad, and you have to review these financial statements. What should you be looking for? So that's really the focus this month. Before we get to that, I would like to raise the concept of are you audit ready? And that is whether it is you still finalizing 30 June financials, or whether you are starting to think about your 31 December reporting obligations or half-year reporting obligations. Kevin and I have been talking about audit ready for a while, and that is how can you save, or how can our clients save time and money during an audit? We don't want to waste, we don't want to be last minute, we don't want to do repetitive work, we don't want to work overtime, but how can you save time and money? The other thing that we've been talking about is how can we help clients, achieve commercial outcomes which represent their business model while still complying with Australian accounting standards. So often Australian accounting standards are not black and white. There's a bit of grey. Quite often Australian accounting standards have a number of acceptable outcomes. And how do our clients ensure that they achieve commercial outcomes aligning with their business model and not necessarily just following what the auditor would like them to do? So that kind of independent advice. Also, looking at financial statements with a fresh eye, the importance of somebody coming in looking at financial statements with a fresh eye. The other thing, the fourth thing that Kevin and I often do is we do IFRS advice for clients, and then clients have conversations with auditors, and they say, Kevin, Aletta, could you please come and join the conversation? I had a conversation like that yesterday, where we help the client to fully understand or convey a certain position to auditors and have a healthy discussion and debate about the best outcome within compliance with accounting standards. Or, preparing or position papers, developing accounting policies, evaluate significant judgments, alternatives, consider their impact. What are the alternatives available? Are we just going for the easiest alternative, or are we modeling the outcome over time? And then obviously, my personal favorite, all the lease calculations and disclosures. So the question really is around audit ready. Do you think you've been audit ready during this audit season? Do you think there's scope to address your audit readiness going forward? Are these things that you would find interesting and need help with? In order to help our clients to be audit ready, we've come up with a few initiatives. And one of them is we've launched 2 weeks ago our BDO IFRS Training Hub. And in this training hub, and I've got a link there, and I've also got the YouTube video where I explain it. In our training hub, it's really a hub where we bring together webinars, we bring together virtual workshops, we bring together e-learning, and we're saying if you want to stay on top of financial reporting and accounting standards and how it impacts your business, if you want to be audit ready, this is the place to go. And there's a number of complementary items there. The other thing that's in there is our virtual workshops, which is, I would say, similar to our master classes that we've been running on COVID-19 and lease accounting. So virtual workshops, it's not limited to a time or a place or a location, let's put it that way. It's virtual, it's using Zoom, it's a small workshop where there's proper case studies, there's workbooks, there's interaction with presenters. And again, it's all about being audit ready. So that's another initiative. Then just yesterday, we've released our September 2020 accounting news. And in there, a lot of important information. One of the things is there's a new optional concentration test to assess whether you've acquired a business or not. And if you use that optional concentration test, it could save you time and money. There's also a reference, an article on why should a for-profit entity consider early adopting or early transitioning from special purpose to tier 2 general purpose. What are the sweeteners in the deal if you transition 30 June 2021? So we're already in that year. So practical advice. And in that accounting news, Nick Martin, one of our advisory partners, have actually written an article on how should businesses navigate themselves out of what we're currently experiencing around COVID-19. So what's going to happen when we get to the significant reduction or maybe removal of JobKeeper and rent concessions and government stimulus? What can businesses do to plan for that life post COVID-19? So it's a really informative article that I've loved reading. It's in the accounting news, but it's looking at business and business problems, the focus on your business. So that's been released, and I've got the link there again. So the focus of today's webinar, as I said, we want to look at better managing your financial reporting risk. And last month, we looked at what do finance team or how do finance teams assess their financial reporting risk? And we asked finance teams to do a risk review using 6 clicks. Now, this time, we've tried to reach out to as many board members, members of audit and risk committees as possible and said, could you please do this risk review for us? Because I am very interested to contrast and compare how finance teams assess financial reporting risk as opposed to how boards and members of audit and risk committees assess financial reporting risk. And, if there are differences, how can we manage that and how can we increase communication between the different teams to get them, or the different groups to get them on the same page? I want to say that if you haven't done this risk review, it's not too late. We are in an ongoing process to get more people to do this risk review. This is a link to our website where you can find the risk review, or it gives you instructions. You do it from your mobile phone, and that's what I love the most. You download the 6 Clicks app, and it's really fast and it's free. And then you do this BDO risk review in this app. You know, you swipe right if you think it's relevant, you swipe left if you want to remove it, you do your assessment, you get a little report at the end on how you've assessed financial reporting risk. And we will we capture who is completing all of this, and we will circle back to you on the findings of our whole group. So you'll see, if you look at some of the findings I'll share today, last month we looked at finance teams, and this month I will capture finance teams again. And there's been a slight change between last month's findings and this month's findings, because more people have completed the risk review, or more people that are in finance teams have completed the risk review in the last month. And therefore, there's a slight change in a few spots. Not big changes, but a slight change. Therefore, you know, if you want to have your say, please do so. We are continuing to update our information. So, you know, we are interested in how do boards assess these risks? How do finance teams? Is there a difference? You know, how do we manage all these financial reporting risks? Because if we manage these financial reporting risks appropriately, you should be audit ready. And that's really what Kevin and I do. We help clients to be audit ready. So there you can see what it would look like on your phone. If you download the app, that's what you'll see: financial reporting risk review, BDO. These are screenshots on how you do it. You know, you go to 6 clicks and the normal, you download it. And, you know, 8 or 9 screenshots on exactly how you do it. Very easy. And you can see the last one here is the report that you'll receive. And I've got that yellow circle. That yellow circle won't be on your iPhone. But I've circled it there because you can see there's a little person with a plus. If you want other people in your organization, in your finance team, other members of the board to complete this risk review, or then, you know, please add them there, and that would be great. It would go to them, the link, and they can also do it. The other thing that Kevin and I are really interested in, it would be fascinating if we can work with individual boards or individual organizations to do a risk review for that board, that audit and risk committee, that finance team, and unpack why there are so many similarities or differences and how we can manage the resulting financial reporting risks. So a lot of options here, but at this stage, we're doing it at a fairly holistic level. Now, one of the key learnings from last month's webinar, where we looked at likelihood of a risk happening, we looked at the potential impact of a risk, and that combines into an overall risk rating. You will remember that the number one financial reporting risk was cash flow. I think business people would have been very excited to see that. And then the causes we listed and we discussed, and then the potential impacts, you know, the decrease in net asset value, cash flow forecast are materially different, impairment of assets, going concern issues, you know, big potential impacts. Now, the weird thing is, the day after we presented the webinar and shared those findings, I've attended an internal workshop, and I listened to one of our BDO partners, Bill Cole, a tax partner, tell a story on how he's managed to get cash or increase cash flow at a number of clients. And I was fascinated because the previous day our clients told us that cash flow is their number one financial reporting issue. The following day, I listened to this presentation. Therefore, I said, Bill, when he finished, please join us in this webinar. You've got 3 minutes, and please tell us and please tell our clients how they can do this. So, Bill, before we share the findings for boards, you've got your 3 minutes. Please enlighten us with your ideas so people can increase their cash flow.
Thank you, Aletta, for that introduction. Good morning, ladies and gentlemen. As Aletta's clearly delineated, I have 3 minutes, so I won't mince words. Slide, please, Aletta. what I wanted to mention to you today is a scheme put in place by the government to return the tax that is included in the cost of fuel to businesses who use fuel for business purposes. So it's called the Fuel Tax Credit Scheme. And to reiterate, if a business buys fuel for use in that business, fuel tax credits prima facie are available. The scheme is a generous one. At its best, it returns up to 42 cents per litre of fuel, which is the full excise rate. The idea of fuel is a broad one. It includes petrol, diesel, solvents, and some gases. It's noted by the ATO also that the scheme is underutilised, possibly by up to 30%. So what that tells me, everybody, is that that there is significant underclaiming or non-claiming in business. Finally, many businesses claim credits to a certain level but miss out on maximising their returns. I'll share with you that most of my experience of recent times have been with claimants, existing claimants for fuel tax credits, who are missing out on claiming the full rate. And over time, of course, that can be a significant amount of money. Obviously, the claiming process is through the BAS. So if you're BAS positive, it's direct cash in the bank. If you're not BAS positive, it'll reduce your outgoings in terms of cash. So what do you have to do? It's an obvious existing form that's uncontentious. It's got lots of rules, of course. You need to review your expenditure. Do you purchase petrol, diesel, solvents, gas, or similar products? If the answer is yes, review your claim. Are you claiming, and at what level and rate are you claiming credits back? Remember, I said the maximum rate is 42 cents per litre. If you're not claiming 42 cents per litre, you should be asking yourself why. Finally, a lot of the issues around the maximisation or non-maximisation of claims relates to how you view your fuel use and how you calculate your claims. And this is the area of significant art, I suppose, in the fuel tax credit scheme. Obviously, the scheme has evolved over the years, has lots of rulings, has lots of caveats and opportunities. So the final point is significant in terms of how you assess your position. So bringing those three things together, you should be able to come to a view as to whether or not you're getting the most out of this scheme and maximising your cash flow. Aletta, I'll hand back to you. You've got a rich presentation coming forward, but I urge the businesses on the line to review this well understood program.
Thank you very much, Bill. Thank you for your time. You know, when I listen to Bill present on war stories and successes, I found it really easy to understand. And, you know, if somebody can explain it as simple as that, I can understand it. So if this is something of interest to you, please contact Bill. I've got his contact details in there. Thank you, Bill. I appreciate your efforts to join us today. And we hope that our clients can get some savings. So if we look at differing views between boards and finance teams, you know, is there a difference? On that risk review using 6 clicks, we identified all of these risks. So we threw it in there. We had a bit of a description, a bit of a common cause, and potential impacts. And, you know, it all fits on one little screen, each one of them, and you do your assessment. So these were the things we've put in there, right? This was the starting point. And then we went through an analysis of our findings. And the first one was around which risks were identified as most relevant. And last time we shared with you that finance teams looked at it, and for this year, number 1 was lease accounting, which made me so excited. Number 2, accounting standards compliance in general, fair value, impairment, Revenue recognition. You know, impairment, IFRS 9 is new. Revenue recognition, IFRS 15 is new. Lease accounting, IFRS 16 is new. You know, I think fair value and impairment, we've got COVID, and then obviously accounting standard compliance. So that is how finance teams have rated it, and it's fairly similar to last time. So this is just about most relevant. But look at boards. Boards have assessed lease accounting number 1 as well, accounting standards compliance number 2 as well, but they then also included staff competency as the third item if we look at most relevant, communication and reporting framework. So if we put the two next to each other, interesting things here. Lease accounting, obviously, it's a hot topic, big impact on the balance sheet. Accounting standards compliance, really important. Otherwise, you're not going to get an unmodified audit opinion. But that's where the difference, where it's the same. And then after that, I found staff competency important. I think boards acknowledging that staff and the work they do throughout the year really important, very relevant, important to have the right staff, understanding accounting standards, understanding the business, pulling it together, because boards are not hands-on involved at that level. So staff competency, they acknowledge is very relevant. Communication is relevant. I think communication between finance teams and boards, but also boards to the stakeholders and the shareholders. But communication, really interesting. And then reporting framework. You know, our reporting framework, general purpose, special purpose, the level of disclosure is so important. It's actually linked to communication. So I thought this was really interesting. So if we just look at the most relevant risks, we already see a little bit of divergence. So that's the first one. If we go on and we say, okay, of the risks that were identified as being relevant, which are most likely to impact you in some way? So when we asked finance teams, they had impairment, lease accounting, uncertain tax positions, IFRIC 23, staff competency, interesting, staff competency would impact them, foreign exchange, all right? What did boards things would most likely impact them? Board competency, number 1. Number 2, remuneration. And remember last month, Ben Renshaw, Mark Griffiths came to talk about underpayment of staff and underpayment of casuals and the recent court cases, etc. Big risk for boards, most likely to impact them. You know, if we hit the papers around we're underpaying staff, it's a big impact. So board competency, obviously, if we've got a problem at board level, that would impact us. Remuneration to me is linked to brand. You know, it will damage our brand. Complex transactions. You know, if there's complex transactions, how does a board deal with that? They're not hands-on with it every day. But that complex transactions could go horribly wrong potentially. Obviously, cash flows, and then the audit relationship. So for board members, they're actually flagging that the relationship with the audit, Kevin, linking to are we audit ready, is really important. And I think it's really important that the boards have a open and honest, robust discussion with audit teams, that there's a good relationship there, but it's also a healthy debate. So really interesting. So again, if we put it next to each other, you know, finance teams, to me, it feels as if it's more around the things that are most likely to impact them are most likely to have a big impact on the financials, impairment, lease accounting, uncertain positions, foreign exchange. And yes, you know, if there's a problem at a staff competency level, that'll be a problem. However, at the boards, to me, it's a little bit different. It's a bit at a higher level. It's around board competency, remuneration linked to brand, complex transactions linked to brand in a way, cash flows, and that audit relationship. So quite different on the most likely to impact finance teams and boards. Then the next question or piece of analysis is which risks are most likely to have a serious impact if they happen. You know, to put it in context, sometimes we would say it's quite unlikely for certain things to happen, but when it happens, it will have a very serious impact. Or sometimes it's very likely to happen, but the impact is going to be low. So in the previous set of questions, we just looked at the likelihood of something happening. Here we're looking at the impact. How serious would the impact be in isolation at this stage? So finance teams, cash flow will have a serious impact. Uncertain tax positions, foreign exchange, complex transactions, revenue recognition. So that was last month. Boards were saying cash flow will have a serious impact. Remuneration, underpayment, etc., serious impact. Reporting framework, if we get that wrong, materially, a serious impact. Board competency will have a serious impact. If we get that wrong, serious impact. And impairment will have a serious impact. So again, if we put it together, really interesting. Finance teams and boards, both when they rank this and they look at the impact, cash flow's number one. But then it's a slightly different. I think boards, again, it's more around the brand, the impact of damage to the brand around remuneration or getting the reporting framework wrong, or if there's an issue at the top around board competency or impairment. So again, a really interesting way to look at it. However, finally, if we go through the process, I've stepped through this. First, do we think a risk is relevant? Okay. If a risk is relevant, how likely do we think that's going to happen? Next step, if it happens, how material or how significant is the impact? Now, if we combine all of that and we get to our overall risk assessment, and we can put it slightly differently and say, which risks do you have to manage very closely to ensure you meet your financial reporting requirements and deliver a smooth and a successful audit for your organization? So that overall risk rating, pulling everything together. Finance teams, and this is where there's been a slight change from last month. Finance teams at this stage, we've got uncertain tax positions as the overall risk rating. We have to manage this. Foreign exchange, cash flows, impairment, and revenue recognition. So there's been a slight change in the order. It might be that 1 month later, people have started to experience a lot of pain around uncertain tax positions. IFRIC 23, and I know transfer pricing, people are working really hard in that space. But this is what finance teams were thinking, overall risk rating. And if you look at boards is holding steady, cash flow number one, remuneration, brand damage, complex transactions, board competency, reporting framework. So if we put it next to each other, really interesting that the finance teams, to me, it's very much the numbers, where at the boards, to me, it looks like a slightly bigger picture overall risk rating perspective. I think at this stage, I'll just pause. Kevin, I've been going really fast. Is there anything you wanted to add based on the data we've gathered and shared here?
Yeah, it's probably just an observation, and I think it's just like you and just like our listeners today, I think this is all new, and we're still trying to unpack a lot of this. I'm starting to see, shall I call it, the 4 C's emerging: cash flow, competency, compliance and complexity, and maybe that's a bit of a buzzword we can use later on. I mean, that probably doesn't encapsulate everything, but clearly cash flows is important, and that's fine. That's, you'd expect that. I mean, organizations can't stay alive if they don't have cash flow. But where it starts to kind of move apart a little bit between boards and finance teams are, and as you can see on the screen there, complexity, managing complexity, which boards should be doing. But I'm starting to get the impression that there is some sort of a misalignment between boards and finance teams on compliance. And in fact, I think in a way, there is still this feeling that IFRS and financial reporting is a compliance exercise. But more and more, when you look at this, what they're actually telling us in their risks rating is that they need financial information that's not just for compliance, but that it can actually help them manage competency and complexity and cash flow and impairment. So what I'm actually starting to see from this is that there is a need to move away from just financial reporting that are compliance exercises and actually move them towards financial reporting that actually adds value to boards and finance teams as they move forward. But anyhow, that's just an initial observation.
Thank you very much, Kevin. That is really valuable. Again, I would like to invite anybody that would like to participate. So board members, members of audit and risk committees, finance teams, please participate. Please do this risk review so we can get better data. The more people we do it, the better our data. The larger our population, the better. If you want to get other people, invite them to join, because I think ultimately we would like to use this data to help finance teams, to help boards to better manage their financial reporting risk. And please reach out if you would like to discuss this any further, or if you'd like us to work with your organization to do a risk review. That would be really good. We will also carefully analyze our data and the trends, and we will keep you informed as we go along during our webinars, accounting news, and other insights. So Kevin, at this stage, after I've been rambling on, I'll hand over to you to look a little bit at the details for 30 June 2020. If you're a director and the set of financials land on your iPad, what should you be looking for? Based on our experience in reviewing financials, what are we seeing? What should our attendees be looking for? What should boards be looking for? Over to you, Kevin.
Thank you, Aletta. And yes, Aletta's already alluded to the fact that this feedback's coming largely from our experience at 30 June 2020. Now, 30 June 2020 reporting season isn't over yet. I mean, to a large degree, we've really only touched the surface with a lot of the listed entities who had to lodge before certain deadlines and so forth. But it's also years and years and years and years that's been building up in terms of what should boards be looking for when they review financials. Now, just remember on today's topic, it's what should boards be looking for when reviewing financials. So there is the assumption that the board and management are separate in this case. And what I actually went for first is it's actually an article that's been on my mind for some time now. It's from 2019, so it's probably before COVID-19, but I don't think COVID is going to change this. It's a survey done through the Harvard Review. It comes from a organization, Russell Reynolds, and I've given you the link there. And it's called Going for Gold. Now, this comes from I think it's a survey of something like 750 boards. It is probably American weighted, but it does kind of give us an indication of where the international community is when it comes to what is best practice and what is top priorities for boards. And having a look at this, financial statement review, which is the topic for today, is slap bang in the middle. And what is interesting is that the average board versus, shall we call it, the gold medal board goes from 28%, where's all boards, to the gold medal board, which is 11% of their time or their priority spent on financial statement review. Now that's really interesting, because the moment you look at that, you think, oh, gee, I should be looking less at financial statement reviews. And that may be true, But what it's actually telling you is that boards shouldn't be looking at financial statement reviews as a compliance exercise. That's the role of management. What boards should be doing is looking at financial statement reviews and look at the financial statements that are put in front of them and saying, what is this telling me about my organization in terms of strategic planning, internal controls, management, performance measures, and how the narrative of, let's say, major transactions are reflected in financials. So this is a really good article for you to go and have a read, and about the culture of boards. And it's really telling you that yes, financial statement review is important, but the review itself is not a compliance activity. And that's what's looking on the right hand side. What you should be doing as a board is looking less at the compliance with IFRS and more at the, shall we call it, the strategic side of what are financial statements telling me about the organization and about my management team and about the execution of the board's strategy and so forth. And I have a couple of good examples that I'm going to share with you today, which I think best demonstrate this. So moving on to the next one, this was one of the first slides that Aletta had up on the screen today, which was which risks were identified as most relevant to boards. And the reason why I put it back up here is because at this point, the relevance of accounting standards compliance was actually number 2. Interestingly, it really shouldn't be there if you've moved to the gold standard, because accounting standards compliance, that's something that management has to worry about. But I think what's happening is that a lot of boards in Australia are still struggling with IFRS and its complexity, and with the staff competency in the organization maybe not being quite there, which is why Aletta and I are saying, you know, are you audit ready and can we assist you with that? It's because that level of competency isn't there yet, and so boards are still, it's still relevant for them to make sure that they need to worry about compliance as a compliance exercise. So the first thing before you can do that is to actually understand where you are in terms of compliance with accounting standards. Are you just complying? Or have you moved beyond compliance and you're actually using your financial reporting information to tell your story, to execute upon your strategy, and to actually manage the communication, number 4, with your stakeholders and with your finance teams? So let's have a look at a couple of examples along the way. One of the very first things I look at when I do a financial statement review is to actually understand whether the board and management are talking the same thing. And the quickest way to do that in a listed environment, if you are in a listed environment, is to make sure that the segment reporting, which is within the financial statements, and that's the segment reporting is a disclosure domain of management, whether that aligns with how the chairman and the board are actually talking about things in their review of operations in shall I call it, the broader annual financial statements. And here's a key example of an example I came across in the last reporting season. Now, it is a live example, but it has been amended for dramatic purposes, shall we say, but also to keep things you know, confidential and not referring to anybody specific. But it is an example of something I see quite a lot. And that is when the chairman or the board in the annual report talk about the business in a certain way, but when you look to the financial statements, which have been prepared by management in accordance with IFRS, they don't actually align up. And here's an example. On the left-hand side, I've got the chairman talking about the operations, that the company operates in sales, development, and marketing in 6 market sectors. And in this case, I've got sale and marketing, clinical trials, consumer technologies, licensing, SaaS, and patents. But in the actual financial report, which has been prepared by management in accordance with accounting standards, the company has identified one operating segment, sale of devices, and management has determined the reporting segments based on the reports reviewed by the board of directors that are used to make strategic decisions. Right off the bat, I'm going to say to you that there's a misalignment between the way management is either viewing the company, understanding the strategic direction of the board, or even just maybe the accounting systems and the accounting financial information just don't line up. On the board, on the one hand, thinks that they're doing 6 different things in different sectors, whereas management, on the other hand, is looking at the business as one operating segment, being the sale of devices, and the information systems internally seem to be aligned that way. Now, this is a live example, and Interestingly, if you're a board member and you're looking at the financials, the quickest way to actually decide whether your management team is aligned with your board strategy is to make sure your financial reports and your annual report line up. And I'll say this out there for those of you who've ever actually been on the receiving end of an ASIC query on financial reporting. ASIC look at this way as well. They make sure things line up from the annual report to the financial statements. It tells the user a lot about how the board and how the management team align their objectives. So this is actually straight out of operating segments. It's AASB 8. Not everybody will comply with this standard. Generally, only listed entities will be complying with this. But arguably, the most important judgment from the standard, if you are doing segment reporting, is the identification of the entity's chief operating decision maker. Now, that's a term used by the accounting standards. That's often, but it could be someone like the chief executive officer or even a group of executive directors. And that party, whoever they are, will have the function of allocating the resources and assessing the performance of the organization, making sure that the business is running according to the board's strategic plan, making sure that the financial reporting information system aligns up. In the example before, it is very seldom that the board itself is the chief operating decision maker. That might be the case in smaller listed, but certainly not in larger listed organizations. So the first thing is identifying that party. And if we look at one of the disclosures they've made, the management were clear when they said it was based on reports reviewed by the board that are used to make strategic decisions. That should send alarm bells through the board. If you are reviewing a set of financials and your segment report from management says that the board is making strategic decisions based on information that thinks there's one segment, but the board thinks they're actually operating in 6 segments, that means there's an internal misalignment. We're not even talking about IFRS anymore or about compliance with accounting standards or even what the stakeholders think. This should ring alarm bells to the board when reviewing financials that the internal communication, the internal reporting systems, and even just understanding what the strategy of the board is not getting through to the organization. That's one of the quickest ways to see that things are going wrong in an organization. So just a bit of a summary of what I've actually said here. What are these financial statements telling the board if they're reviewing these financials? It's not clear who the chief operating decision maker is. There appears to be a breakdown in communication here internally. It's not even clear to me who was in charge operationally and who's been told to execute on the board strategy. What information is the board getting? It doesn't appear that the information that the board is getting upon which to make its decisions is even aligned to the 6-segment strategy. And the competency of the staff and the advisors that are advising management may be a little bit off in this case. And so competency, communication, financial reporting framework, all those risks that Aletta has identified in the 6 clicks as being relevant to boards are triggered right here. Things should be ringing alarm bells to the board. The actions of the board right now should be to review and make sure that the strategy and the operation aligns and that the roles and objectives of the management team and the key performance measures are clear. And then the other thing you want to look at is whether the internal information systems are actually aligned. Those are all board responsibilities. Now, often there can be a very, very, very easy reason why those 2 disclosures don't align between the annual report and the financial statements. But sometimes it can be critical. It's telling you something as a board that you need to take a step back and say, before we even release these financials to the outside world, are we getting everything internally right? And is management and the board on the same page? So that was a really interesting example, and I thought I'd share that with you. Using the same one, I've actually just highlighted the word development here. Right now, a lot of organizations are in a development stage of sorts, where they're trying to develop new products, new technologies, or even just get themselves onto an online platform, because obviously trying to sell in traditional retail outlets or whatever might not be the same as before, and the online portal is now really, really important. So development to a board member when you're reviewing financials should tell you something about your asset base. So if I see development, I always first ask myself, what are we developing? And is that development going to give rise to an intangible asset that I can capitalize onto my balance sheet? Now, using an example here of this entity, I have a look at my disclosures and I see that I've got an intangible asset from last year to this year of 40,000 and it hasn't moved, which means that this company is developing something, or at least it says it's developing something, but nothing has been capitalized. So this takes me back to the intangible standard. Now remember, your asset base is your portal to the future. It's telling stakeholders that where you're building future value. Intangible assets can only be recognized on the balance sheet if you have demonstrated these 6 points: that you've got technical feasibility of completing the asset, intention to complete, ability to sell, you've been able to describe how you will generate probable future economic benefits, that you've got the resources internally to complete, and just that red one that's just highlighted on the screen, you've got the ability to measure reliably the expenditure attributable to the asset during its development. If you are an entity and you are in a research and development phase, and let's say you've hit the development phase and you are able to capitalize expenditure that related to the development phase, if those expenditures don't appear on the balance sheet, it tells me more often than not that the last one of that list has not been complied with, which means your internal accounting systems are not able to clearly distinguish your expenditure from development versus other expenditure, and which means your internal control and financial reporting systems are not working as they should, because ultimately you're just going to end up expensing everything. And that's one of the big things to take away from as a board. What it should be telling you, if you are in development phase and you're actually not capitalizing anything, it means you've lost the opportunity to capitalize those costs as an asset, but it also means you've lost the opportunity because you haven't devoted enough resources internally to building a proper internal costing system, a costing system that can appropriately cost the development expenditure and essentially create the asset on your balance sheet. So the actions of the board in that scenario is to make sure that your internal control systems are strengthened, that you've got a cost capitalization policy for expenditure that can capture the amounts that are directly attributable to the development expenditure. I have been astounded at the number of organizations that are actually in development stage at the moment. Everybody's taking advantage of COVID-19 to actually put together some development systems, even those that are moving into the cloud. So with a Microsoft cloud systems where they're moving everything into a SaaS environment, some of those expenditures can be capitalized as software development expenditure. But if you don't get your internal costing systems right, you lose the opportunity to capitalize those expenses and they just go straight to profit and loss. And as a board member, if I was looking at a set of financials and I noticed I was going through a development phase of sorts on any type of intangible asset, but those expenditures were not arising on my balance sheet, it tells me something about your internal cost capitalization systems, and it's maybe something you want to interrogate management over. And then finally, some golden oldies, and this is goodwill. There are a lot of acquisitions going on at the moment in the background, mergers and acquisitions and so forth. And with that comes goodwill. Now, goodwill is generally the starting point for what will eventually become an impairment exercise in the next financial year. Goodwill, once it's on the balance sheet, needs to be tested for impairment. The problem with impairment is that if you start to worry about how you're going to test your goodwill in a year's time or at the next financial reporting period, it's often too late at that point to actually strategically manage goodwill as an asset. If you don't set up the goodwill when it arises at the time of the acquisition, very often it's the first to be written off because of impairment, and it doesn't have to be that way. Goodwill should be looked at the time of the acquisition. So if you're on a board and you're reviewing financials and you've just gone through an acquisition and goodwill appears for the first time on your balance sheet, here are a couple of questions that I would be asking right now. Don't wait till impairment in a year's time. Ask the question right now. The first one is, why is goodwill so large? In accounting, the standard setters don't intend for goodwill to actually even be recognized. The idea of an acquisition is that all intangible assets that you've acquired in a business combination should be separately accounted for. software should be separately accounted for. Brands should be separately accounted for. All these assets that actually come with the organization you're buying should be separately identified, valued in a purchase price allocation, and separately accounted for. If you've got an enormous goodwill number on your balance sheet, what it means is you might not have identified all the assets that you've acquired and separately accounted for it, because ultimately goodwill is the balancing figure. So everything that's not separately accounted for is ultimately wrapped up in the goodwill number. The problem with that is goodwill's the first to go when you have impairment. And once you write goodwill off, you can't write it up again. Most assets, if they're written down for impairment, that impairment can be reversed later if things turn around, but not goodwill. So as a board member, if I was looking at financials in the year of acquisition and I had a massive goodwill number, I would ask the question, are we sure we have identified all the separate intangible assets? Because down the line, when you're going to write something off, it's going to be the goodwill that goes first, and you never get to reverse goodwill once it's gone. So first question. The second thing is to understand that if the goodwill number is correct, understand what it's made up of. Now, this is actually a requirement of the standard. The standard actually requires not only for you to understand why the goodwill number is there, but you're actually meant to disclose it in the financials in the year that it arises. And you need to say to the stakeholders, the reason why there's goodwill is because we think it's going to be the synergies that we expect from the business acquisition, or we think that there is an unidentified intangible asset out there. Sometimes you can't actually separately measure all the intangible assets that are part of goodwill, but at least knowing what's in there helps you understand and helps you account for it later on down the track. Or it might even be that you've just paid a premium. And let's face it, goodwill can arise. You're a board, you're trying to get an acquisition across the line. Now, what happens is you're going to pay a little bit extra, more than what the business is worth, because let's face it, you need to get it across the line, and that's part of the negotiation. That's fine, but understanding what the goodwill is made up of can help you better achieve an accounting outcome down the track. And I'll give you an example. Synergies, which arise from a business combination, often don't belong to the actual business acquired. They belong to the business that has acquired the acquiree. So goodwill, when you do goodwill impairment testing, you need to allocate the goodwill to the various cash generating units that are going to benefit from the acquisition. And synergies often don't belong to the acquired business. They belong to the acquirer, the entity that's making the acquisition, which means some of the goodwill that arises actually should be allocated to the existing business, the acquirer, and tested for goodwill in another cash generating unit of the acquirer. If you don't do that and you apply all the goodwill to the acquiree that's just been acquired, you could overcapitalize goodwill to one business unit, which means that it is at much higher risk of being impaired down the track, because the goodwill hasn't been allocated across all the units that are expected to benefit from the acquisition. So that's one of the reasons why understanding your goodwill right now and where it belongs can help you strategically allocate it across the business to make sure that you can minimize impairment down the track. A lot of the goodwill write-offs that we see, especially in this downturn period in 2020, arose because the goodwill was not correctly allocated right at the start. It got allocated to the incorrect business unit at the beginning. You get stuck with that allocation, and then sometimes, because all the goodwill has been allocated to one business unit, that one business unit alone has to justify its continued existence, and you often end up finding the goodwill gets allocated or impaired really quickly in that case. So I'll leave it at that. Those are some golden oldies to look at. There are many more we could talk about, but we don't want to go too far over today. With Aletta, I'll hand back to you.
Thank you very much, Kevin. Really, as always, very informative, very practical, and I really hope that our board members and also our finance teams have picked up some really good tips on looking out for differences and maybe disclosures that would flag to the market that we've got differences. I like the angle around things that would indicate issues in internal controls. Fantastic. Thank you very much, Kevin. At this stage, I would like to circle back And I would like to circle back to what I know the number one problem is, and that is cash flow. And I thought, after listening to Bill, uh, let's do a poll. And I've got 3 poll questions. And the first one is, do you purchase any, let me just have a look. You know, at this stage, you know, do you purchase diesel, petrol, or solvents? Because if you do, I think Bill has given you some food for thought. And I thought it would be interesting to see how many of you actually do purchase these diesel, petrol, or solvents. After listening to Bill a few weeks ago, I actually went back to my list of clients and I did an analysis of how many of them have own vehicles, lease vehicles. Therefore, I expect them to purchase a lot of diesel, petrol, etc. And you know, and I'm in the process of contacting them and saying, "Do you know about this? Are you currently doing something in this space?" So I think that is, you know, it definitely resonated with me just thinking about my client base. All right. So thank you very much for that. I think it's really interesting. I'll share what our attendees have indicated here. 66% said no and 34% said yes. So there's 34% of the people that I think definitely have to consider, you know, do we manage this? So the next one is, if you do, so if you were the people who said yes, I suppose the next question for you would be, do you currently claim these fuel tax credits through your
And I
base?
wonder if you don't know whether you claim it or not, then you should answer no to the question.
Because I think I would have expected as a board member, if you know that you spend a lot of money on fuel, I would hope that we can very confidently say, listen, we are claiming our fuel tax credits. And if you can't say that confidently, maybe there's an opportunity for you to claim it. So that would be really interesting as well. I'll leave it a little bit longer. All right. So if we look at that, you know, do you claim your fuel tax credit? So we've got 76% said no. I think so. Maybe it's a food for thought. Is this something that I should be doing? If cash flow is my number one risk, you know, is this a way to manage it? And then the other thing is, you will remember that Bill actually said a lot of people do, or businesses do, claim fuel tax credits, but not at the correct percentage or the maximum rate of the 42 cents. You know, so maybe it's not just, am I claiming it? Am I claiming everything I can claim? Which is another angle to explore. So definitely every day, but especially during COVID-19, we do not want to leave money on the table. When I speak to our tax partners who help clients with R&D claims or R&D incentives, or whether I speak to Bill when we talk about fuel credits, why would a business leave money on the table? All right, so I think that's maybe the real thing. So here we've said, you know, do you think you're claiming at the right level? 25% yes and 75% no. All right, so that's just some interesting additional data. So if we go back to, you know, do you need assistance? I just want to make sure that I close that off. Yes. So reiterating, Kevin and I are both in advisory. And what makes us tick, other than accounting standards, I know, which is very sad, but the thing that really gets us excited is when we can help clients, and if we can, in particular, through our advisory work, help clients to be audit ready. So we are not auditors, we are advisors, and we want to work with clients to get to the best commercial outcomes, but still complying with Australian accounting standards, and to help our clients to be audit ready, to have position papers in place, to develop appropriate accounting policies, to document why their judgments is appropriate, consider alternatives, not in a rush, but in a structured fashion, manage lease obligations. So this is what we like doing. So, if you wanted to speak to any of us to assist you of that, please feel free to reach out. I think it's really critical that we do not run into issues a week before we sign an audit report. But that we identify issues early on, manage it appropriately, do the appropriate research, get to the best possible outcome before the auditors arrive. So please feel free to reach out to us. I would like to say, as always, Kevin, lovely to present the webinar with you. Thank you for your time and energy that you bring. So thank you very much to all our attendees. Lovely to speak to you. Please reach out for any further discussions, and we'll speak to you again next month. Bye-bye, Kevin.
Goodbye, everybody. Goodbye, Aletta, and have a good week.